Well, hello everyone. Welcome to Trading a Smaller Account. My name is Barbara Armstrong, and this is an active trading class. And by that I mean that we place lots of trades in this class and we follow up on lots of trades in this class. So I know that this is called Trading a Smaller Account, but you might be in a position where you have a large account. Maybe some of it is invested on a long-term basis and some of it on a shorter-term basis, and you want to trade a portion of it. And this is a class that can help you develop that skill set. So today we're going to follow up on a bunch of the trades we've placed. We're going to place some new trades, and that's what we do in this class. If you are not following me on X, you are missing out, my friends. I've also got the fantastic Mr. James Boyd in the house in the chat. And James and I have known each other for years. He's a friend and a fellow coach. We tease each other. I don't really tease him about being an American, but he likes to tease me about being a Canadian. And so, we have a great repartee between them. We're going to talk about a stock that we have kibitzed a lot about over the years today, Crocs, and we'll get to that in a minute. And, our banter always used to be to not mock the Crocs. But there we go. So follow James and I in the land of X, James Boyd CS, Barb Armstrong CS. If you miss out, if you don't, you're missing out. And you can find us on LinkedIn now as well. So hop on over to LinkedIn and you can follow us there. Know that options carry a high level of risk and aren't suitable for all investors. We do a lot of option trades in this class. Okay. And we use the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to kind of hone your skills, develop your trading plans, all of that kind of good stuff before you consider trading in a live account. But no, there are some nuances and differences. One is that short option positions will never be assigned early. Two is that if you buy a dividend stock, it doesn't pay a virtual dividend in paper money. And there's no guarantee that in a live account that dividends, are going to continue to be paid. So that's something to keep in mind. Also know when we use a stop loss order, it doesn't guarantee that we'll get out at the price requested. Okay. So we tend to do a very quick market overview. If you miss Trader Talks today, I think James might have been running solo, but it's typically James and Kevin, and Kevin does Trader Talks 4 days a week. And so gives a fantastic market overview. So ours is very, very skinny in this class so that we have more time to manage our existing trades and then place new trades. Okay, so let's get right down to it. And I do have one announcement to make as we get started, and that is that and Will, typed into the chat. And I want to thank all of you here who are so engaged in this community and in the chat. So to BJ and Bob and Rocky and Billibury and Virgil and Kevin and Riceberg and Sharon and BJ and Will and the rest of the gang. Thank you all for being part of this group. But like Will said, the Barb 3.0 project, last year I called it the Barb 2.0 project. I had been hit by a car as a pedestrian back when I was a teenager, and my knee finally said enough is enough. And so I had that replaced, and it was a great success last year. But now my hip and femur are joining the Me Too brigade, and so the Barb 3.0 project begins on Monday. So I'll be out for a couple of weeks. Connie will be filling in for me, and she does that really beautifully. And she actually filled in for me while I was at an event in Chicago a couple of weeks ago. She placed 3 trades in our paper money portfolio. All of those worked out beautifully. And we've got 2 of them that we're going to review today. One of them we reviewed on Monday. And so let's have a quick look at some of what's been going on in the account. So when we come to the monitor tab, we can see that we have one order that we ended up out of today, and that's Amazon. It was a long call vertical. And I went back and looked at what happened in the last 5 days. If you're just wondering how I keep track of this, it can be hard, but we meet on Mondays and Fridays. And so I came back and said, okay, let's just look at what has happened in the last 5 days. And so we have, had a lot of closes in the last 5 days. And when you look at it, most of it is long call verticals. And then we also exited a position, we opened a position on Monday on Philip Morris that hit our target on, I think it was Wednesday on the 28th. Now, I'm not going to go through all of these in detail, but just quickly, we'll walk through the first one. And the first one was Amazon. That closed today. So it closed basically at the market open. And now I'm going to go back 25 days. And so we can see that on Amazon, we bought a long call vertical for 250. We did two of them. So we were risking $500 and we exited that position for 410. And so how much did we make? Well, the math is pretty simple. Oh, that drawing tool is not going to work today, so we're going to use this one. Okay, so we look at this 410 minus 250. So we made $1.60 a share or $160 a contract. And then we had, two contracts. So that's times $200. So we made $320 in total. We call that a base hit. You may call it a double. But we're pretty happy with that. And if we want to look at our return on risk, because how much could we have lost? We could have lost that whole $250 a contract. And how much did we make? We made $160 on our $250 investment or risk. And so that came out to a 64% return. Okay. Okay. So that's that one. Let's clear that. Now, the next one was CRM. And CRM we bought for $225. We were out for $420. And so our return was even higher on that because we made $195 per contract. We did two contracts, and our return on risk on this one was 86%. Now, Connie did this one in our example trading plan. For this class, we're typically aiming for 50%. And, on this one, we did better on that. And we made in total on this one $390. So again, our goal in this class for the year, and we started the year at 25,000, was to make $100 a week. And I picked that because somebody had typed into the comments of one of these webcasts that it was ridiculous to think that you could average $100 a week on an account of this size. And we've achieved that target. If you think, that's $5,200 over the course of the year, we're ahead of that now, because we're up almost 6,000. And so we changed our goal and we said, okay, we're going to go for $200 a week by the end of the year. And we'll just see if we can achieve that. But that was our goal. If we said, well, if we wanted to generate a little extra income, that's $400 to $800 a month. And that might, that buys a lot of groceries or whatever. And I mean, these are paper money groceries. You wouldn't feel very full after eating a virtual, prime rib, but there you go. So I'll clear that one. So that was CRM. And then, and again, this was a long call vertical. And then we did one on Target or Target. And again, in for 275, out at 405, about 2 weeks later. So we were in this trade for 2 weeks. And our return on that, we made $260 when you do the math. And you can go back and watch this and stop the recording. And if you're saying, how did she get to that again? We subtract one for the other. We multiplied that by 200 because we did two contracts. And then our return on risk on this one was 47%. And if you're saying, well, I thought your goal was to get out at 50%, well, sometimes when you're placing these live in the market, you end up setting your target not quite exactly at 50%. And so that might be how that happened. And then we did two on J and J, and we thought we'd compare them. And actually, I will confess, I was surprised by this in that, so J and J must have had a nice move to the upside. Let's look at the chart on this. So we ended up getting out 2 days after we got in. And so it came up and we probably got out very close to the high of the day on this. So yeah, so let's come back and look at this. So we got in on the 24th, we were out on the 28th, and the 24th was a Friday. And so the market was closed for 2 days. So it was closed the 25th and 26th. We were in it Monday. So we were in it for three trading days. And what we did is we thought we'd compare and contrast the $5 wide spread to the $10 wide spread. But because it moved up so dramatically, we got out up both on the same day and we made a similar return. Actually, we made a higher return percentage wise on the $5 wide spread. And so if we, go through the math on this, and I'm not going to go through all the details, but you can go back to the recording on this. So when we look at this one on, when we look at this one and we say, okay, we got in at 265, we got out at 420. And so we made on that one $1.55 per share or per contract. And because this one, we were risking 265, we did two contracts. So on this one, we made just over 300. So we made 310. And our return on risk on this one was 56%. Now, on the one that was $10 wide, so let's go to blue, we got in for 465 and we got out for 725. And we did one contract because we didn't want to risk more than $500. So on this one, that one that was $10 wide, when you do the math and subtract this from this, we made on this one $260 times one. So we made 260 and our return was 47%. And so you might say, well, obviously it's better to do this than this. Well, not always, but that's how this particular example worked out. But what I was hoping to point out was that sometimes when you have a narrower strike band, if it just goes up modestly, you might end up getting out of this one faster than the one with the wider strikes. But as it turned out, we got out of both, on the same day. So there went that argument. But maybe, we try this again. Or maybe it isn't as significant as I thought. Like, this is the beauty of paper money, is that you get to keep practicing and figure out how, these play out, right? And the other thing to take into account is that on the Schwab Thinkorswim platform, it's 65 cents per leg. There's a transaction fee. And so you might say, well, why isn't she talking about the transaction fees? Well, it's $1.30 per contract to get in when you have two legs, and then $1.30 to get out. And so, we made $50 more here, but we paid $2.60 in transaction fees. Now, this is a difference in paper money. You're not actually paying the transaction fees, I believe. And then on this side, we paid $5.20 because we paid twice as much because we had two contracts instead of one. But we made $50 more, so that more than compensated for the extra $2.60 that we spent. So I just wanted to address that, because when I do these tighter bid-ask spreads, and sometimes we'll do ones that are $1 wide, and people start going like, what about the transaction costs? It's like, yeah, what about them? So it's Part of the cost of doing business is like, if you're driving somewhere, you need gas, or if you have an electric vehicle, you need to have it powered up. It's just part of it's just part of trading. Okay, so that was J&J, and then we did one on Philip Morris. So those are the long call verticals. And then we did a trade on Philip Morris. So let's come out and look at Philip Morris. So, and we placed, okay, so this was a different account because we don't have enough money to do a buy right covered call on Philip Morris. But on Philip Morris, let me just come and look at this. Philip Morris. I think we just placed that trade on Monday. So it was July 27th. So we placed the trade on Monday and we put it in a target. And so if you're looking at it and going, why didn't you put it in the charts? We had a target here of 206.50. So I'll just edit this. So we put in a target of 206.50. So this was like a classic swing trade. We just said, like, could we make a little money if we bought some shares? So we bought the shares here on Monday, and on Tuesday it hit our target. And we got out for 206.50. And then the next 2 days it fell. So we're really glad we put in a target that managed it for us, because on that one, we ended up making, if you do the math, 206.50 minus 194.98, we made $11.52 a share, and we had 25 shares. And so we made on that one $288. And this was a stock trade. And you may say, well, like, what was your return on risk on that though? Like, because you invested a lot more money, right? Yes, we did. And I actually didn't calculate that. So 1152. And how much were we investing? Well, $194 a share. So if I take my 194.98, so I'm just going to do that on my calculator here. 1152 divided by 194.98. That was almost a 6% return. It was a 5.9% return on our investment. And you can see here that we did an OCO order. So we had a stop. And there's never a guarantee when you use a stop that you'll actually get out at the price requested. And we had a target. And so when the target was filled, then the stop loss order was canceled. And so, on this one in total, we made $288. So it was a good week for the account, because in total with these, we were up by $1,568. So given that our goal was to make $100 to $200 a week, not a bad week. But we had one trade that didn't cut it in half, but it put a big dent in it. And that was IREN. And so IREN, and we lost on IREN more than we wanted to in that. So we did a buy right covered call, but it was up a fair distance in the channel. So where we put our stop, we ended up losing on that one $638. And we don't want to lose more than 500 to 550. So we took a heavy hit on this one. And let's come and look at the chart and see kind of what went wrong. So on this one, on this day, it had come down to a support level. It's been trading in a range. And we said, hey, the premiums are so rich. What if we just hold a buy right covered call up here at 50? It was bouncing off the support level. And instead it came down, and I put our stop on the chart here. And so here was our stop at 30. What was our stop? Just a sec. Let me see if I got that right. Our stop was at, we did a market order. Our stop was at 31.25. I guess I need to edit that. It was 31.25 was our stop. And again, there's no guarantee that you're going to get out at the price requested. But the frustrating thing is that it came down, hit our stop, and then it's moved back up. And so this is one of those where I say, like, it just kind of frosts your petunias when you have this situation where you come down, you get nicked out, and then it resumes the uptrend. But today we've got another bearish candle happening, so we're out of that trade, and we may want to continue to watch IREN, and we may just say, well, that was a lesson learned, and leave it alone. But it still seems to be trading in this sideways range, and we do have a short put vertical on it, so Connie will be following up on that one with you guys. So when we look at that here in our short put vertical on IREN, we're up $10.50. And, we had a little profit on it earlier today, but as you can see by this candle, it opened higher and is now moving lower. But here's our short put vertical. We want it to stay above 30. And so we'll see if that happens or not. But this buy right is now done, so we can take that off the chart. Okay, so those are the trades that we've been in and out of. Somebody asked if I'd look at KeyBank. And with KeyBank, we did a buy right covered call. We bought back the call on KeyBank. And now it's moving again to the upside. We own some shares of stock, but we're waiting for it to continue to move a bit to the upside so that we can get more if we sell our call. Because right now, if we tried to sell the 24 call, we'd get 10 to 15 cents. Now we could sell the 23 call for 35 to 45 cents, or we could come out to September. But the idea being, if we're at support and it's bouncing, perhaps we wait a few days for it to move a little higher, and then we get more for the call that we're selling. So the IREN, we don't have a long call vertical. We have a short put vertical on IREN. Okay. Okay. Are we still in Cisco and JPM? So yes, we still have 4 long call verticals. We're underwater a little bit on 3 out of the 4, but all of them are up today. So those 4 are CrowdStrike. Let's just, if we have a quick look. And I don't want to take the whole class on this, but CrowdStrike, which is moving again to the upside, you can see when we place the trade. In an average day, this stock can move, has moved on average almost $10 a day, $9.38. So it's at 187. We want it to be at 205. So that's entirely possible in the 3 weeks we have left. Cisco, there's our long call vertical on Cisco, GE, and JP Morgan. So we're just hanging tight. We aren't, the deal on these is if we're up 50%, we want out. If we're down 50%, we exit. And so we're not, in that spot on any of those. Okay, let's go look at something new. And because I have James with me today, James, I know I'm spoiling you, but any chance to tell the James Boyd Crocs story, where James is out working in his yard, sporting his lovely Crocs, and didn't put sunscreen on his feet. When he took his Crocs off hours later, he had little polka dot sunburns all over his tootsies. So I laugh every time I look at my Crocs thinking of James. But, we've just had an earnings announcement on on Crocs. And when we look at it, UBS raised their price target to 120. Well, it's already, over 126. I don't know if they got the memo or if they think it's going to go down but when we come down here and we look at this, B of A raised their price target to 160 from 145. We've got Piper Sandler at 150. We've got Stifel at 125. We've got Baird at 150. It's interesting to me that this is what these guys do for a living, and there's such a range, but we're looking at this diagonal support level and diagonal resistance level. And could we maybe do another swing trade like we did on Philip Morris? Not to say it'll work out the same way that Philip Morris did, but yeah, like we have this bullish engulfing pattern occurring here. And what if we bought $5,000 worth of shares? That's our max position size. We have 27,000 sitting here doing ding qua qua. It's sitting in cash. So could we take $5,000 and say, I want to get out at 140 when it gets up in that neighborhood of this previous resistance level? And we could make, when I looked at it this morning, it was 15 at 125. But if we could make about $14 a share, 13.84, like that wouldn't be too shabby, And so if we said, okay, well, how many shares could we buy? Well, we could buy about 40 shares. And so we'd put in a target at 140. And if we said, well, here's our low here, if we take this low here, and it's ironic that the low was 120, if we go 3% below that, we'd put a stop around 116.40. And so if we look at this and say, okay, we would like to buy custom with an OCO bracket, we're going to look at 40 shares. And when I click and turn this firecracker into a paperclip, when I click anywhere on these lines, it then evens up the quantities. We're going to make our target 140. And our exit, we're going to put at 116.40. And then when we come in and look at this, this is 5,048. So we're close enough. It counts in horseshoes and trading, I'd say. So we're looking at our goal is to make $13.73 a share on an investment of 126.27. Now, I'm not a mathematical genius, but that smells a lot like about 10%, right? Right. And we're risking $9.87, but it's not times 100, it's times 40. So if we said, okay, what's 987 times 40? It's 394.80. So if it did hit our stop and we don't want to lose more than 500, even if we didn't get out at the price requested and we got out a bit lower, we have some buffer before we'd be over 500. Cahill's asking who's going to be at the market drive in Dallas. Kevin Horner and is going to be there along with Joe Mazzola will be there. There will be, lots of familiar faces, and Ben, of course, Watson will be on stage. We're expecting between 800 and 1,000 people. And I'm a little bit pouting that I'm not there, but yeah. I'm having surgery Monday, so I got grounded, people. Can you believe it? Okay, so this is a stop with a target, and we're just putting in a note that this is basically a swing target. Okay, so fire in the hole. Now, could we have done a short vertical, or something instead? Well, we could. Now, if we come out just 21 days. Now, when I looked at this earlier this morning, the bid-ask spreads were just too wide. But, now they're like 40 cents. Now, if we come out here, that's a buck. That's a little wider. 580 to 760. Like you could drive a truck through that. So September isn't really an option. Sorry, it's not really a choice. Cahill, I think there will be many class regulars at that event. Yeah, it looks like Riceburg isn't going to be able to make it. I don't know if Will's going to be there. But you know what I encourage you to do is introduce yourself to each other. And I've made friends when I was a client attending these events that I have to this day. And so it's really neat to be surrounded by like-minded people. And so, you know, I encourage you to check it out. Yeah, and reach out and make some friends. Okay, so with Crocs, could we do, you know, this long call vertical 125, 130? We have a target of 140, so our technical analysis is indicating that we think this might go up. So if we did this, what would we be paying? Well, 230. If our goal is to make a 50% return, we'd say 230 times 1.5, 345. How many of these could we do? We could do 2 because we're still risking less than 500. First trigger sequence, we're going to right click, create an opposite order, and make our target 345. And then we can compare that to the stock trade. So I'm going to put a little note in here, long call vertical compared to our stock swing trade. And then we can just compare and contrast. And that's one of the beautiful things about, you know, being in a learning situation. Okay, so we're going to compare that to our stock swing trade. And so there we go with Crocs. And if you're thinking like, well, why did we pick August instead of September? Because of the width of the bid-ask spreads. But, you know, the advantage of this is if it does continue to go up, it might reach our profit target quicker. But if it falls, we have less time to recover. Okay, so that's something that we have to be aware of in picking our strikes. And then with our example trading plan, we want to look at stocks that trade 1 million shares a day or more. We're still early in the trading day. So when we looked at yesterday, that was 3 million. But when we look at the day before, which is more indicative of a regular day, you know, we're typically, we would average 1 million shares a day. And then when we look at our when we look at our volumes here, you know, do we have at least 20 times the number of contracts we want to trade? Yes. Yeah. So somebody said, well, Crocs is below the moving average. And yes, but when something is trading in a big swath like this, it tends to weave when it's trading in a range through the moving averages. So that's to be expected when you see something that's trading in a sideways range. And this is kind of in an uptrending range, but it's, you know, kind of moving like a wave, right? And then it came down. We just had earnings. We had a positive, you know, response to earnings here. Well, it came down, but it beat on earnings. You know, and then today we have this bullish engulfing at a support level. It's in an uptrending range. Okay, so that's that one. Let's look at Bank of America. Now, Bank of America, we had recently done a buy right covered call, and that worked out really nicely in that example trade. But now it's trading over $60 a share. And so we can't do another buy right because, you know, our max position size is 5,000 and this would be 6 grand. So it's just slightly out of our snack bracket for our position sizing rules. So if we can't do that, like, could we just buy some shares and put a target? We could. Or could we, you know, do maybe a long call vertical? Could we look at the options? Yeah. So James is saying he threw the Crocs away after I told the story. Oh, I'm so sorry, James. Is it too late to go fish them out, retrieve them, or are you going to have to buy a new pair? Um, Okay, so if we look at Bank of America, so if we come out to August, do we have lots of contracts? It's traded 7 million shares a day, so check. The 62.50, we've got like thousands of contracts. We have a 5 cent, 4 cent bid ask spread. Or if we wanted to give it more time, because this is only 20 days to expiration, maybe we come out and here we've got 29,000 contracts. So we've got lots of liquidity here. And then that it gives us more time. And so we might be in the trade longer, but if it pulls back a bit, we have more time to recover. And so now, do we pick the 62.50 strike or do we go for the 65? So it's already over 62. Like it only has to go up by 33 cents and then stay there for us to be where we want to be. But at 65, it has to hit a new all-time high. So then we might say to ourselves, well, self, if I do this, if I'm paying $1.53, the most we can make on this, the most we can make on this is $97. But if I want to make 50%, that would be $2.29. Like I'm getting close to max gain on that. Or maybe I could lower my sights and say, well, I'd be willing to take a little less. Or you might just say, I'm willing, to stay in the trade a little longer. And so, just being aware of this, that we're getting closer, that's powerful. Now, if we came and we said, well, if we did the 65, we're going to pay, relatively speaking, less. Our target would be, 380 maybe. But it has to move more. So we're going to stay with the 62.50. We are going to do 3 of these because we're risking less than 500 with the 3. Our single order, first trigger sequence, we're going to put in that 50% target. And so that's at 230. And we have until September 18, so we've got time on this one. And make that good till canceled. So we're risking 459. We could lose it all. Our example trading plan is that we exit if we're down 50%. Okay. Now, where am I coming up with this example trading plan? And James, if it makes James feel any better, I was in Florida one time and I diligently put sunscreen all over my feet. Then I put my flip-flops on. I got to the beach, took the flip-flops off. Well, in the little walk across the road to the beach, the flip-flops wiped off all the sunscreen that was like underneath the flip-flops. So I got a sunburn right where the flip-flop should have been, so sometimes you can't win for losing on the sunscreen front. We all have our sunscreen horror stories, right? Okay, so that was Bank of America. And then I wanted to just show you where to access an example trading plan. And so if you come to Trader Talks, so if you haven't already subscribed to the Trader Talks channel, you're going to want to do that. And when you first get here, what we'll show is what's currently being taught. But if you come to playlists and scroll down, there's a playlist for this just dedicated to this class, but there's one called the Trade Management Mini Sessions. And this week I've added 2 new ones. One is what are 3 black crows? So there's this whole series, there's now 15 of them in this candlestick series. What's a hammer? What's a shooting star? What's a bullish harami? So if you're new to technical analysis, you may want to do a little binge learning. And these all tend to be between like 2 and 5 minutes long. And then I've got some example trading plans. There's one here for buy right covered calls. There's one here for long call verticals. There's one for short put verticals. We looked at a short put example. Yeah, so there's that. And then this one was just added this morning. I'll post it on X after the class. But I went to show how to cut this video and it had been taken down. They age out after a couple of years. So I did a new one just on quickly how to customize the option chain. And even if you're not an option trader, what I kind of love about going to the option chain is, like, let's say where we did the Crocs trade. So let's come back to Crocs, and we put in our target of 140. Well, if you add probability of touching, which is what this is, and probability of in the money, we can now come down to, say, August 21st and say, what is the probability of it even coming down and triggering our exit? And it's saying, well, it's 36%. You've got a 17% chance that it will be at or above, but you've got a 36% probability of it at least touching. And then, where did we set our stop? We set our stop at 116. So if we come over here to 115, it'll tell us what our probability is of it coming and touching that. Now, we may say, well, hey, I don't think the likelihood is that high based on our superlative technical analysis, but this is what the probabilities are. Okay, so you can use different features, and some people might not have even known that this probability of in the money and probability of touching existed. And so now you know. And if you want to watch that short video, I think it's about 5 minutes long, I'll post that on X. Now we've got to wrap things up, but and we've placed 3 trades today. So we did 2 on Crocs. We're going to compare a long call vertical to our stock trade with a target. We did a short put vertical on, or sorry, a long call vertical on Bank of America. The financial sector has been very strong. And so I looked at Aflac, and sometimes you may not want to place a trade over earnings, but when you have a stock that's been pretty consistent, low drama, just marching up this hill for months, might there be an opportunity here? And we're not in the kind of snack bracket where we could afford to maybe buy 100 shares and do a protective put. But if we're bullish on this, could we maybe do a long call vertical? So we could look at that. Another one to watch might be Travelers. It's and we're on the other side of earnings. It had a big move to the upside, setting up a bit of a bull flag here. So could you do a trade with a bull flag target or a swing target? Might this end up being a piercing line today where we had this big down day, and then, if this comes up past the halfway mark, that might be considered an entry. So we might want to keep our eye on that one. Bro, maybe I end on the bro. So when we look at Brown and Brown, and like, I play a lot of I Spy with my little eye on this. I don't know where my drawing tool seemed to go, but I see this inverted head and shoulders pattern here. And then, it came up and is kind of retesting this area. And so you may want to wait for, this bounce out of this range in this $70 range, but there's another one to kind of keep your eye on. So guys, thank you so much for hanging with me today. Up next is advanced charting. So you may want to stick around for that. Appreciate you being here. Appreciate James being in the chat and taking my good-natured ribbing. Trust me, he gives as good as he gets. I've got like Canadian stickers and Canadian flags here, so you never know when I may stop by the Boyd residence again. But take care, everyone. I'll be back in a few weeks, and I will look forward to seeing you then. And you guys can look forward to meeting with Connie on Monday of this week, and she will be managing these trades that we've placed and continuing on. So guys, have a great week and a great weekend, and I'll see you soon. Bye for now.